One day, I was staring at a candlestick chart and realized something kind of insane. I had no idea what was actually happening inside that candle. Green means up, red means down, sure, but why did it go up? Who pushed it? How hard? At what exact price level? I had zero clue, and neither do 95% of traders. Every candle is a black box. You see the outside, but inside, thousands of trades happened. Buyers and sellers fighting level by level, and a regular candlestick gives you exactly none of that information. Here's what I genuinely believe. It doesn't matter what strategy you're using. ICT, smart money, Fibonacci, supply and demand, doesn't matter. If you layer order flow on top of what you're already doing, you will get better risk to reward ratios and higher quality confirmations every single time. That's what footprint charts give you, not a new strategy, a better lens on the one you already have. Let's get straight to it. When you look at a regular candlestick, here's what you actually get. It went up or it went down, maybe some volume underneath. That's it. You're looking at the outside of a box. Something happened inside it. You just can't see it. And here's the thing most people don't realize about how markets actually work. Every single trade that happens, every single one, requires two people, a buyer and a seller. There's no such thing as more buyers than sellers in terms of contracts executed. The market is always two-sided. But here's where it gets interesting. Not all participants are equal. Some are passive, some are aggressive. Think about selling a house. You want $150,000, a buyer is offering $120,000. Both of you are passive. You've posted your prices, you're waiting. The market is frozen. Nothing happens. Until someone blinks. The buyer gets impatient. He needs that house. He accepts your $150,000. He came up to you. He lifted to your ask. Transaction done at the higher price. Price moved up. He became the aggressor. Now flip it. 3 months go by, no other offers. You get desperate. You go to the buyer and accept his $120,000. You hit his bid. Transaction done. At the lower price. Price moved down. You became the aggressor. Same house, same two prices, same standoff. Completely different outcome, depending entirely on who moved first. That's it. That's the entire engine of price movement. Passive participants post their prices and wait. Aggressive participants accept those prices and act. And the speed and direction of price depends entirely on who is hitting whom and how hard. In financial markets, this happens thousands of times per second. Aggressive buyers lifting the ask push price up. Aggressive sellers hitting the bid push price down. The passive ones, the limit orders sitting in the book, are just the menu. The aggressors are the clients deciding what to order and when. Footprint charts make that aggression visible. Row by row, price level by price level, candle by candle. Now let's understand exactly how a candle gets built. This is the order book. On one side, passive sellers listing their contracts for sale. On the other side, passive buyers listing their contracts to buy. Below the current price, all the buy orders. Above the current price, all the sell orders. This is the order book. These contracts are sitting in a window display. 7 buyers have each posted one contract saying, I want to buy here at this price, I'm putting it on the table. They're passive, they're waiting. Nothing happens until someone from outside walks up to that window and decides to take something off the shelf. Now someone arrives and says, I'll sell you those 7 contracts. Done. Those 7 contracts disappear from the book. They get recorded in the footprint. 7 contracts executed at that price level. That price becomes the new current price. That's the open of the candle. Then someone else arrives and lifts 5 contracts sitting on the ask above. Those 5 disappear from the order book, recorded in the footprint. Price ticks up 1 level. The candle moves up 1 tick. This is exactly how buyers and sellers move price. Not the passive ones sitting in the book, them. The ones you can't see coming, the market takers, the aggressors. Now someone needs to buy 12 contracts immediately. He can't wait. He hits the market buy button. The book shows 10 contracts available at the current price. He takes all 10, but he still needs 2 more. So the market moves up one level, one contract there, still needs one more, moves up another level, takes the last one. One person, 12 contracts. Price just moved up 3 levels in 1 millisecond. Now someone arrives and wants to sell just one contract at the best available price, whatever it is. He looks at the book. The current level has nothing, empty, not a single contract yet. So he scans down. The first level with actual liquidity is 99. 4 contracts sitting there. He takes one. Now there are 3. That contract executes at 99. Price snaps down instantly. The candle drops, turns red, leaves a clean spike above. Here's the lesson. When you see a candle rip up violently, it's one of 2 scenarios. Either a wave of aggressive buyers slamming the ask, or barely any passive sellers in the book to slow them down. Most of the time, both. Passive sellers are the resistance on the way up. The more contracts they've stacked, the harder buyers have to work to lift price. The fewer of them, the cheaper that move becomes. A handful of aggressive buyers can move price 5 levels if the book above is empty, or barely 1 tick if it's loaded. The footprint chart records all of this, every executed contract at every price level for every candle. To pull it up, open TradingView. If you don't have it yet, click the link in the description. Click the candle icon at the top of the chart and scroll down to Volume Footprint. Now let's read the numbers. Each price level inside the candle shows you 2 numbers. Left side, sellers hitting the bid, aggressive sellers. Right side, buyers lifting the ask, aggressive buyers. 2 columns. Left is sellers, right is buyers. If the right number is bigger, buyers were more aggressive at that price. If the left number is bigger, sellers dominated. Green cells means buyers dominated that level. Red cells, sellers ran it. A green candle can close green while 80% of the volume inside was selling. Price went up, but big money was quietly dumping into that strength the entire way. The candle hides this completely. The footprint exposes it. 95% of traders only see the candle. They see green, they think bullish. Now that you can read the individual levels, you need a way to summarize the whole candle without staring at every row. That's what delta is for. You can find the delta number at the bottom of each candle. Delta equals buyers minus sellers. Total contracts bought at the ask minus total contracts sold at the bid. If 600 contracts were bought aggressively and 400 were sold aggressively, your delta is plus 200. Positive delta, buyers won the candle. Negative delta, sellers won it. Green delta means buyers dominated that bar. Red delta means sellers took it. But delta tells you the final score. It doesn't tell you where the big plays happened inside the candle. For that, you need imbalances. At most price levels inside a candle, buyers and sellers are roughly balanced. 60 contracts on one side, 70 on the other. Close fight, nobody dominating, but sometimes one side completely overwhelms the other at a specific level. You see 50 on one side and 300 on the other. That's not a close fight, that's a blowout. That's an imbalance. You read them diagonally. Compare sellers at one level to buyers at the level directly above, or buyers at one level to sellers at the level directly below. If one side is 3 times or more bigger than the other in that diagonal comparison, that qualifies as an imbalance worth marking. Imbalances show you aggression, not just activity, desperation. Desperate buyers don't wait for price to come to them. They attack the ask at whatever price is available. Desperate sellers don't wait either. They hit the bid hard. An imbalance is the footprint of someone who couldn't wait. TradingView highlights imbalances automatically, as you can see here. Delta and imbalances together give you the full picture, but the real power comes from when you learn to read them as patterns, specifically 3 reversal patterns that show up at every significant turning point in the market. Pattern 1. Absorption. Every buy order needs a seller on the other side. So when aggressive buyers are pushing hard and price still won't move, something is matching every single one of those buy orders without flinching. A large player is building a position in the opposite direction, quietly, using the crowd's aggression to get filled. They don't dump the market. That would tip their hand. Instead, they wait, absorb, and accumulate. What does this look like on the chart? Enormous numbers on both sides of the footprint, bid and ask both, but a candle body that barely moved. All that energy, almost no displacement. The bearish version, price climbing, buyers aggressive, and then a candle where both sides are enormous but price stalls. Buyers exhaust themselves against an invisible ceiling. Then price drops. The bullish version in reverse. Sellers pushing down, price won't make new lows, buyers have been silently absorbing every sell order. Then price launches. Strong positive delta but no new highs? Something is eating that buying pressure. Strong negative delta but no new lows? Something is eating that selling pressure. Volume without movement is never neutral. It's always a setup for what comes next. Pattern 2. Change in delta. Imagine a clean uptrend. Positive candles, higher highs, everything looks healthy. And then one candle forms. Still closes green, still a higher close, but the delta is negative. Sellers were more aggressive than buyers on that candle. Price went up only because the remaining buyers paid increasingly higher prices to get their orders filled. The direction of aggression had already flipped. That gap between price direction and delta direction is the signal. Price and delta are supposed to tell the same story. When they start disagreeing, one of them is about to be proven wrong, and it's never the delta. The same applies on the downside. A downtrend with consistently negative deltas is healthy. Sellers are in control, everything is aligned. But a red candle closing lower with a positive delta means buyers were actually more aggressive on that bar. The candle looks bearish, the internals say otherwise. One diverging candle is a warning, 2 in a row is a conviction signal. By the third, the trend has usually already changed and most traders are still holding the wrong direction. This is the pattern that gives you the earliest possible warning, before price breaks structure, before the reversal candle forms. The delta has already told you. Pattern 3. Stacked imbalances. A single imbalance means one side dominated one price level aggressively. Interesting, but not enough on its own. 3 or more imbalances in consecutive rows, that's a different animal entirely. That's not one aggressive trader, that's coordinated size entering the market across multiple levels simultaneously, fast and with conviction. The kind of activity that doesn't come from retail. When price is rising and a cluster of selling imbalances appears stacked vertically, sellers dominating level after level after level, that's institutional distribution. They're not just present, they're overwhelming the market at every price point they touch. That kind of stacking precedes reversals, not continuations. Flip it for demand. A downtrend meeting a wall of stacked buying imbalances, aggressive buyers at 5, 6, 7 consecutive levels, that's accumulation. That's a zone being defended by size. Price almost always reacts. TradingView flags these clusters visually, coloring the individual imbalance cells automatically. Now, here's what makes these 3 patterns genuinely powerful. They almost never show up alone at a real reversal. Go back and look at any significant turning point on a footprint chart. You'll find absorption first. Volume explodes, price stalls, the war reaches a standstill. Then, delta diverges. The candles start betraying the trend before it actually breaks. Then, stacked imbalances confirm. The winning side enters with overwhelming force across multiple levels. 1 pattern is a signal. 2 is a strong case. All 3 together, at a level that already has structural significance, that's when you stop second guessing and start executing. Absorption told you the pressure was contained. Delta told you the momentum had already shifted. Stacked imbalances told you the new side means business. Let's bring this together into something you can actually use on a chart. But first, I want to thank our amazing community. I'll be rewarding the most heartfelt comments because that kind of support is what keeps me going and motivates me to keep creating free content for you. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux Charts. Now, if you haven't heard about Flux Charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once. So instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part. 90% of their indicators are completely free. Plus, you can use flux charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. Step 1. Check the overall delta. Who won the candle? Is price moving in the same direction that delta is pointing, or are they diverging? If a bullish candle has a negative delta, you're already on alert. Step 2. Look for imbalances. Where did the aggression happen? Are they stacked? Do they point in the direction of the move or against it? Step 3. Check for absorption. Is the move real? Is price responding cleanly to the buying or selling, or is something eating it? Footprints are not a standalone system. They're confirmation. You don't open a footprint chart, stare at numbers, and decide where to trade. That's backwards. First, you go to your candlestick charts on the higher time frame. You find your structure. Where's the trend? Where are the significant highs and lows? Where are the supply and demand zones? Mark your points of interest before you open a single footprint. Then, and only then, when price reaches one of those zones, you switch to footprints. The structure tells you where to look. The footprint tells you what's happening there. Now let me walk you through an actual trade, step by step. Higher time frame context first, always. Here, price has been making higher highs and higher lows. Structure is bullish. Bias is clear. We're looking for longs, and we're looking for them at a level that matters. There's a demand zone from 2 sessions ago. Price came down hard, found aggressive buyers, and launched almost 60 points to the upside. That's not random. That's a zone where size showed up. Mark it. That's your area of interest. Now, you wait. Price rallies, then starts pulling back toward that zone. This is the moment. You don't jump in on the approach. You open the footprint and you watch. First candle that touches the zone. Delta, negative. Sellers were more aggressive on this candle. That's not surprising. Price is still in a pullback, momentum is still down. You're not alarmed, you're watching. You scan the imbalances inside that candle. 2 stacked ask imbalances near the bottom, right at the lower edge of your demand zone. Buyers are starting to show up aggressively at those levels. Not enough yet, but they're there. Second candle forms. Still looks bearish from the outside, but the delta is shrinking. Sellers are losing conviction fast. And now you see it. 3 consecutive ask imbalances stacked at the bottom of this candle. Buyers attacking aggressively, right at that level. You check for absorption. Volume on this candle is high, higher than anything surrounding it. But price barely moved lower. Big numbers on both sides. Massive war, tiny body. That's absorption. The sellers are pushing and something is eating every single sell order. The demand zone is holding. Third candle opens. Delta flips. Buyers won this candle. Price is responding, actually moving up, not just bouncing within the range. No absorption this time. The buying pressure is translating directly into upward movement. 3 green lights. Delta divergence on the way down. Sellers losing conviction before price even stopped. Stacked ask imbalances at the zone. Buyers proving themselves at the exact level. Absorption on the second candle. Selling pressure eaten alive. Then a clean positive delta candle with price follow through. That's your entry. You buy the open of the fourth candle. Stop goes below the low of the absorption candle, below the level where demand proved itself. If price breaks back below that, the thesis is wrong and you want out immediately. Target is the previous swing high. That's where you take profit. Now here's what makes this different from a regular candlestick setup. On a normal chart, this entire sequence looked like a messy pullback into support. Maybe you would have entered, maybe not. You would have been guessing. With the footprint, you saw the absorption in real time. You saw the delta diverging before price reversed. You saw the institutional fingerprint, stacked imbalances at the exact low before the move started. Most of the time, nothing sets up cleanly. That's fine. The edge isn't in trading more, it's in trading only when all three signals align at a level that already matters. Patience is part of the system. Every pattern we covered, absorption, delta divergence, stacked imbalances, can appear anywhere on a chart, middle of a trend, random consolidation, open air between two meaningless levels, and when they appear in those places, they mean almost nothing. Context is everything. The same absorption pattern at a daily high, a level that rejected price 3 times in the past month, carries completely different weight than absorption in the middle of a range nobody is watching. The signal is identical, the probability is not. The most powerful version of this approach layers footprint patterns onto price levels that already have structural significance, a prior session high or low, a heavy volume node from a previous consolidation, a weekly VWAP level, a swing point the market has already tested and respected multiple times. These are the areas where size is positioned, where passive limit orders are resting, where institutions are most likely to defend. If you find some value in this video, leave a like and write in the comments where you're trading from. See you guys next time.